Hey,
Hello.
there
Hey,
we
everybody.
go.
Happy Tuesday. Welcome back to another Stock from Scratch series. We have a doozy of a company
Yeah,
today that this is true, Brian. We ask people to vote on a stock, every Wednesday.
yep.
And a couple days after our thing came out and the stock was chosen, some interesting news came out about it.
Yeah, just a little bit. I think a short report by a firm that typically focuses in other areas has had some success. I think it was Muddy Waters, if I'm
Yep,
not mistaken.
you
They've
got
had
it.
some success in the past. However, this is a different kind of company for Muddy Waters to go after.
This is completely different. And to be fair, we are about to analyze a financial company, and financial companies require a specialized knowledge that goes kind of beyond a deep knowledge,
It's
and a lot of people
it's like
specialize.
it doesn't like you can't take everything you know about a retailer, about a SaaS company, about a restaurant and apply it to a financials company. It's just a unique beast.
I would say banks, insurers, and biotechs are about as hard as it gets.
Yep.
But we will get into that. Thank you guys so much for joining us today. I'm Brian Feraldi. This is Brian Stoffel. And over the next hour or so, you're going to see us research a company from scratch. So the stock that we are researching today was voted on by our members, and Sofi Technologies was the number one choice. So that's what we're going to do today. Now, some companies are easy to
Yeah,
research.
this
Some
one's going
companies
all the way on
are
the right.
hard to research. There's no doubt in my mind. This is about as hard as
Yep.
it gets when
Yep.
you are when you are an analyst. So you are going. If we are especially bumbling around asking ourselves questions on today, that is why it's happening. But we would love to know: do we have SoFi shareholders of watching us today? Please let us know in the chat. If you're a SoFi shareholder, if you're a prospective shareholder, Mr.
Yep.
Stoffel, is this the stock that you own?
No, not a stock I own or follow. So if you hear me say lots of dumb things, don't be surprised. What I will say is two quick things. One, I know the company is now run by, I think it's Anthony Noto, who was the CFO at Twitter for a really long time. I remember that. And number
Oh,
two is that if you're a short seller, it makes a lot of sense to put a short report out about companies like this,
yes.
because the harder it is to understand, the harder it is to refute the claims that you make, or to be able to tell what's signal, what's noise. And I will say, looking through this, we do have a fair number of people that own this, probably more that don't, but we do have a fair number of owners that are joining us today.
Great. Well, love to see that. Now, if you've been following the stock and you know anything about this stock, this is the report that came out by Muddy Waters on the 21st. So about 3 days ago. So in between us kind of picking the stock. And I've already got some questions from people via email if we're going to be covering this. We will touch on it at the end if we have time. But I do want to point people to this Twitter account, Timothy Sweeney. This guy has been going deep into the details of here, and he seems to be quite adept at analyzing SoFi. And this tweet he just came out with basically that says every argument of this short report has been refuted. If you want details, I would definitely recommend going to X, following him, and reading some of his recent tweets. He's been doing quite a good job with keeping up on this. Those that don't,
Tim _ Sweeney _ TAR.
Yep. And again, so if you don't know me, I'm Brian Feraldi there on my long-term returns in the blue.
And that's me, Brian Stoffel. Those are mine in the green at the end of the previous year.
Yep. And we're going to be showing you how we research a stock from scratch using Stock Simplifier. Now, the research process that we teach in Stock Simplifier, 7 steps that we go through, but we explicitly warn you when you use Stock Simplifier, there's a couple of stocks this doesn't work that well on. Banks are definitely in that category. So the key metrics in particular are not going to be all that meaningful here. The valuation, I'm going to suggest we pivot to using price to book or price to tangible book instead of price to earnings ratio, although we can look at that. So let's just keep that in mind. Now, the first question for us to ask when we're analyzing a business is what phase of the business growth cycle do we think SoFi is in? So let us know in the chat here if you've researched SoFi before. Which of the 6 phases of the business growth cycle do you think SoFi is in? Now, while we get some feedback on that, I'm going to load up a fresh copy of Stock Simplifier. I will zoom in a little here. I will go to the phase analysis, SoFi, and I'm going to open up a fresh copy of Fiscal. I'm going to open up a fresh copy of the AI prompts.
And I will say,
we're
we're getting everything from 2 to 4 in terms of where people think it is. I would say our average is 3 thus far.
3? Okay.
But
well, let's go ahead
2 to 4.
And load the AI prompt into Gemini. We're going to tell we want to research SoFi and see what it says.
I will say I did go on to Fiscal to look. I would say between 3 and 4 would make sense.
I would think that also makes sense. My guess is going to be phase 4. I think it's going to be in the operating leverage phase, but we'll see.
Zoom in a little?
Yes, I can. There we go. Okay.
There we go.
So Gemini, the AI we're going to be using for this, also says phase 4. Very high confidence. Why? Because operating income is positive, $480 million. Revenue is growing about 40%, but they are not they're not returning capital to shareholders. So they recently
raised equity, yeah.
$1 billion, even though they have $480 million in positive operating income. So that means that forward metrics are going to be useful for the company. Dividend yield model, price to sales model, kind of things like that are going to be less useless for us. So it seems like most people were in agreement that phase 4 does make sense for our analysis here today, Stoffel.
Now, Brian, just so some folks know, some folks joining us are actually members of some of our premium communities, and they have access to the product we have not yet launched. Just in case you are in that group, you won't be able to analyze this with the version we have, because my understanding is SoFi is not in the S&P 500. That's
correct.
Right. Okay.
That is correct. Okay. All right. So now we know about that, and we've identified the phase. Let's go ahead and learn about this business. How does it make money? What are its key products and services? Who are its customers? Where does it operate? And how frequently do they buy? So I have our business analysis prompt here. I'm going to go back to Gemini, and we're going to start learning about this business. Have you researched this company before?
No, not really. The only thing that I first heard about this from Mr. Money Mustache, of all places, because it was an alternative. This before it went public. It was an alternative place to put your money. And I think they got their start in helping out with student loans, but I could be wrong with that.
I think that's how they got their thing too. I do know that SoFi stands for social financial.
Okay.
So that's where SoFi comes from. People mostly know them from SoFi Stadium, which is where the Rams play.
Mm-hmm.
So I mean, that's a big expensive thing to do. Okay. So this is as of the most recent 10K from February 2026. What does it do? It's a digital financial services company that opts as a one-stop shop for consumer finance. Suite of services, personal and student loan refinancing.
There you go.
Mortgages, checking and savings accounts, investment, credit cards, all integrated into a single mobile application. It's a modern bank.
And it seems to me like akin to the type of thing that we see like Robinhood doing. We did Robinhood recently, where you start out in one thing and then you expand and you leverage the fact that you are an app downloaded on millions of millennial smartphones. So
and there's a word we love that describes that.
Yes.
Optionality. I have no doubt that SoFi is going to have that in spades.
It's similar to Lemonade too. It reminds me of.
How does it make money? SoFi generates revenue in 3 segments: financial services, lending, and technology. Okay. Lending is the biggest platform, $2 billion, or more than half of revenue. This is interest income and gains on the sale of personal student loans and home loans. So lend out money, charge one interest rate, raise money or use internal deposits at a lower interest rate, and the spread is what you keep. That's banking 101.
Yeah. And I imagine those are private student loans.
I would imagine so too. But when it comes to that, the thing that matters above all is credit quality.
Yep.
The loans you're making actually going to be paid back, which depends on who you're lending to, what your standards are, what's the backdrop for the economy, what's the unemployment rate, all that kind of stuff.
I do wonder if I know student loans you can't discharge in bankruptcy. I wonder if those are just government student loans or if private student loans can be or cannot be discharged in bankruptcy. Just curious.
Good question. I don't know. Financial services. So this is 30% of revenue. Referral fees, payment processing, and net interest income from SoFi bank deposits. So this is like traditional service fees. So I'm guessing referral fees and stuff like that is like if they sell a loan or they get you to open up some other type of account somewhere else and they're referred to doing so. Payment processing, that makes sense. And net interest income from SoFi bank deposits. So again, they're making money when you deposit with them. They're paying you a rate below what they're earning on their income. And then this is the one that I heard of initially.
Yeah, same here. Our friend Brad Freeman talks about this a lot. He's also a good follow for SoFi.
Absolutely.
And this is what I hear him talk about the most.
Fees charged to other financial institutions for using SoFi's core banking and card issuing processing infrastructure, yet just 12% of revenue. This is almost like a SaaS product.
I imagine that it's very high margin, though.
Yeah. Well, let's do some deeper dive into that. I guess we'll finish with the prompt and then we can go a little bit deeper dive. Who are the customers? They're targeting Henrys, high earners, not yet rich. Well-educated, high-income consumers who underserved by traditional banks, other fintechs, and regional banks through its Galileo technology platform. So it's targeting young high earners. Great. Where does it operate? Pretty much exclusively in the US, although it has a small presence with these technologies in Latin America. I believe it bought Galileo.
Yeah, it might have.
If memory serve.
One quick note too. One of our watchers says they cannot be, or they can be discharged private student loans in bankruptcy.
Okay.
So that's a risk worth noting.
Thank you for noting that. Yeah, and if you have insights that we are not covering, please share them.
I'm going to stop you again. I'm going to stop you one more time. This is just a stream of consciousness here. If they're focused on Henrys, high income, not yet rich, I imagine that includes a lot of entry-level white-collar jobs. Mm-hmm. And I know that SoFi is down 50% since last Thanksgiving. So not that long ago. I'm thinking out loud here. I wonder if the erosion of those entry-level white-collar jobs, that's exactly who we're talking about, them aiming for, if that might have something to do with this.
It's possible. I would suggest that if you are a entry-level job, you are also not a high-income earner.
Yeah,
so
could be.
So I think what you're talking about is the right thing. That's the top of funnel for them, mm-hmm. right? That's new users.
Sure.
Their bread and butter is the people that are actually high interest.
That makes
high
sense.
Income. But absolutely something to keep in mind. Okay, how often do customers buy? The business models on financial service product loops. Customers enter through a high-frequency product, SoFi Money or Relay for tracking finances, and eventually transition to higher-value long-term products, personal loans or mortgages. Retention is high as members manage their entire financial lives with one app. Yeah, recurring revenue, no doubt.
Yeah.
Can it raise prices? Pricing power through its cost of funds by utilizing its own bank charter to collect low-cost deposits, which were $27 billion. It can offer competitive loan rates while maintaining healthy net interest margins. The technology platform uses a per-account fee model that scales so it can't really raise prices.
It has a cost
lower
advantage.
Costs.
Yeah.
Do you buy that?
I don't know enough about banking to know.
I can't imagine that it has a lower cost deposit fund than big competitors.
Wells Fargo,
JP Morgan, right? So I don't know. So answering the question, can it raise prices? The question you're trying to get at there is, can it get more profitable per person? Mm-hmm. And the answer is, it probably can't raise prices, or maybe modestly can, but it can lower its costs. That I buy. So it can become more profitable as it grows through raising prices. Even
so it's not on the revenue side; it's on the cost, spreading out the cost side. Yeah.
Right. So in that sense, you don't need an advantage over your competition. You don't need an advantage. You just need to be able to do it internally.
Mm-hmm.
Okay. What happens in a recession is sensitive to interest rate cycles and credit quality. Yeah. Underline, double score, bolding. Banks are very sensitive to interest rates and credit quality. It's one reason why I personally don't invest in banks, is because there's this massive thing that is completely outside of the bank's control. So same thing with an oil company. You're dependent on the price of oil. Gold company, you're price on the price of gold. With a money company, a bank, you are dependent on the price of money, which is interest rates.
Mm-hmm.
In a recession, loan demand typically decreases and default risks rise. Management notes that their higher income member, the average income is $160K for personal loan, historically shows greater resilience during downturns than the general population.
I don't know.
So,
See, I would still just say, like, I know people who have been laid off in this recent, like, AI is going to wipe out jobs thing. Like, I know people who are in that bucket who've been laid off because of this. So
yep.
I just wonder if that plays a role.
Well, okay. That's a great thing to keep in mind. I would think save that for the risk section.
Sure.
But for right now, we just want to know about this business. What do you guys think about just the business? What we just learned, is this a business that confuses you? Is it a yellow business? So you get it. Or is this a green business? Is this a business that you would say excites you? Would love to know what you guys think based on what we now know, just again, focusing on the business. While we're waiting for those things to come in, I do like to go to fiscal and go to financials and go to segments and KPIs and just see what they have in there. So, okay. So we have revenue sources. And if we take a look at all the revenue sources and we bar chart them like this, so you can kind of see how fast each one is growing. So this is lending. So, okay, lending has been the big revenue source forever. And this is growing at a 31% rate. Technology, I'm guessing this is the Galileo.
Yes.
This is growing at a 224% rate, although that's off of such a small base. Looks like year over year, 315, 350.
It's actually not that much.
It looks like single digit.
Yeah.
I'm guessing if we bring this forward to, let's just say 2020, that number will look substantially different. Okay, yeah. So this is growing 30%. This is growing 36%, although much slower recently. And then finally is financial services. Okay, so financial services is really the driver here.
Yeah, the Galileo only grew 14% last time.
Yeah, but this business, the financial services revenue, which I would say of the three of them, if you said which ones excite you as an investor, financial services is much more exciting to me than lending revenue.
Yeah, personally. But I would say Galileo would be the most exciting to me.
Yeah, but it's also the
business dynamics.
For sure. So yeah, this is the best revenue, but it's just the smallest, second best, and then least desirable. That would be how I rank them. But it's at least like 50-50.
Yeah. For fiscal, do they give profitability per segment at all?
I don't know. We'd have to look at the income statement for that. Revenue before.
Oh, no, I think it would probably be in the segments and KPIs. Because I want to know if they give margins, for instance, for... Nah, they don't.
They do give net income.
Yeah.
Or take that
net interest income. Yeah.
By segment. So again, lending is $1.8 billion business with $1.6 billion in net interest income. Makes sense. Financial services net income is 50%, half, and then the technology. Well, obviously, there's very little net interest income from that, so that's not a very fair. Oh,
there we go. This is what I'm looking for here.
Okay, so you want me to?
Look at that, financial services. Yeah, see, that's interesting.
All right, so let's take a look at those.
764. So the great thing is you can see how important Galileo is, even though but obviously those financial services are the most important.
Yeah. So what we're looking at here is non-interest income. So effectively, I'm going to call this gross profit for the lack of a better word. So financial services is doing a good job there. Wasn't their revenue lower than that?
Yeah.
Okay. Yeah, this is why banks are hard, right?
Yep.
Because it has these kind of things in there. But this does show you that the Galileo punches above its weight from a revenue perspective.
Yes, exactly.
From a business,
I want to
importance
know why that explosion in financial services. That would be the first thing that I would go and investigate.
Yeah, and they're clearly doing a good job there. But anyway, so what do people say about the business overall? What did you see?
Overall, we got everything: yellows, reds, and greens. But on average, it was yellow.
All right. Well, I'll just say, okay, yellow's good there. I understand with a caveat being this is a bank and banks are hard to understand. Okay. All right. Well, at least we got more about this company done. All right. Up next is the Moat. We want to know what is the source of this company's moat and what is the current direction of this moat. So there are 5 moat sources: network effects, switching costs, low cost production, intangibles, and counter positioning. We want to know from you, what do you think is this company's primary moat source? It might have multiple ones, but what do you think is the number one source of the company's moat? So I'm going to go and copy out our prompt here, head it over to Gemini, put this in here
in the chat,
and we will do some analysis on what do we think of this company's moat. And we're going to go category by category, but I would love to see what AI says. Okay. They say narrow, but getting wider. So AI says this is a narrow moat currently, but it's widening. The biggest moat sources are switching costs, network effect. Prove that one to me. Okay. SoFi's financial services productivity loop creates significant ecosystem stickiness, evidenced by the 40% of new products were opened by existing members. This internal cross-buy behavior reduces customer acquisition costs and increases the friction of customers for leaving.
So
I buy that sentence right there.
Land and expand.
Land and expand. Exactly. The typical SaaS model. Okay. Switching costs. So if you forced me to say it, this would be my choice.
Yeah. I would too. I like this comment. You have no reason to switch once you're in it because they offer everything that at least this person sees.
I haven't switched banks in 24 years.
Yeah. No, and you starting with student loans makes a lot of sense, right? Because that's right at the beginning of your financial
right when you develop a relationship with the bank.
Yep.
Yeah.
Makes all the sense in the world.
As a high friction ecosystem, by bundling direct deposit, high yield savings, stock investing, and multiple loan types, they increase the gravity of the platform. Absolutely, they do. Users
totally buy it.
Setting up automated billing, the logistics for migrating becomes a significant deterrent. Totally buy this. It just says narrow. I might even be willing to go wide on that. But okay, we'll just say narrow. Okay, so 20.2 million total total products, up 37%. 40% were opened by existing members, a 7% point increase year over year. Our ability to consistently deliver durable growth and exceptional credit, our strategy in a battle test environment. Okay. Network effects. While consumer app has limited, its technology platforms exhibit a classic B2B network effect. As more fintechs and banks join, gains more data to scale and improve the core banking, making the platform more attractive to institutional partners. It's the AWS of fintech model. I don't know. Do you buy that?
I think it's weak. I like that it says narrow and stable, because if I was going to give it something, that's what I would give it. I don't know enough about Galileo to know.
All right. Enabled accounts, 157 million. Total accounts, member group.
Now, those are the accounts with the banks that use their system. So those banks have 158 million accounts.
Interable to innovate, and it's now allowing a broad range of companies to bring innovative programs.
I think it's nice optionality.
But again, if a new bank signs on to Galileo, does that make the platform better for all existing customers?
This is the exact same thing like 2 years ago when you and everyone would say AI gets better the more data you have. And we always said, yeah, prove it. I don't know, because you have to prove that to me. I don't know.
Yeah, I'm personally not going to give them much credit for this. As a, I would say switching costs, if anything, would be higher there. Once you joined, it'd be hard to join. But anyway, I'm going to give them moat credit either way. I just would question that one. Intangibles, while SoFi has a high brand awareness, it's lacking true pricing power, typically associated with the Mindboat brand. Banking products remain highly commoditized and a significantly lower APY. So if they drop their APY or raise their interest rates, it would likely stall their growth. Its primary advantage is a superior digital experience, which is an operational strength instead of a durable, intangible asset. I would say that this analysis here is pretty great, pretty good.
Yep, I agree.
Pretty good. I would really agree with that. And while
I would
people
want to
know the
go and
name,
see their SG&A as a percentage of revenue and how that, and see if that's coming down.
so people are knowing the brand name. It ranked number 1 in investor satisfaction. Yeah. So I would say that this is developing. I wouldn't give them any credit for it being a moat source yet.
So non-existent, but widening.
Yes. Non-existent, but widening. Low cost production, narrow and widening. Their bank charter is a primary cost advantage. So they have 30.7 billion in low cost member direct deposits to fund it rather than relying on expensive lines of credit. So SoFi is significantly lowering its cost of capital. So this is a bank charter. So I would almost could put that under intangibles.
Intangible. I could see. Mm-hmm.
Yeah. I mean, this is just classifying it differently. It's saying by having this bank charter, which is an intangible, it's lowering their cost of capital, which is giving them a low cost production. Again, I wouldn't give them a low cost production over the incumbents.
Yeah, I want to know who Gemini thinks that their key competitors are. That's what I want to know.
Yeah. I would imagine it's every bank out there that would be an alternative, right? Is it a broker? Is it Yeah. Okay. The vertical integration allows for superior unit economics compared to non-bank fintechs. So yeah, I would say over non-bank fintechs, having that charter and Galileo does give them advantage. Yeah. I would buy that.
But again, you've got to keep in mind that as they grow, that's not who their main competitors will be. So for instance, I just looked on Gemini and it said its main competitors were Robinhood, PayPal, Chime, Upstart, Affirm, and Ally. Other than Ally, I wonder how accurate that really is, because as they grow, it's going to be more Wells Fargo, JP Morgan, so on and so forth.
Yeah, but if Wells Fargo, JP Morgan, if they're going after a different segment of the market, right? The older, more established, and if they're not growing, who you compare them against does matter. So, but if you compare them to those ones that you just said, I would say having a bank charter does make them stand out.
Yes, I agree.
Yeah. Okay. A net interest margin. This is a key metric to chart for any bank. 5.72%. So this is the difference between the spread that they pay interest at and they earn interest at.
Spread.
That's a big spread.
That's a big spread.
Very big. Very big. I think most banks are 3 to 4%, roughly.
Wow.
So that's a very impressive number, especially if that is maintainable. Was 100. The average rate of deposits in the third quarter was 190 basis points lower than that of our warehouse facilities. Wow. So getting that bank charter significantly advanced their net interest margin. Okay. Counter positioning. This is, do you offer a business model that incumbents can't compete with? SoFi was originally counterpositioned against traditional banks by being digital only. However, incumbents have heavily invested in their digital capabilities. The Big Four can do super app. So SoFi no longer benefits from that. I would say fair enough. Okay. Biggest risks, credit quality sensitivity. You are correct. A severe recession could spike charge-offs. A charge-off with just 3% of personal loans. Competitive landscape. Chime, Robinhood, and incumbents. This model is a battleground, and their high PE ratio. Okay, so Morningstar says no moat, but it's stable. And analysts say
no, that's Gemini. Gemini.
Yeah, that's Gemini. Yeah, okay. Well, what do you guys think? If you guys were rating this company's moat, no. So red is no moat, none at all. Yellow would be some moat, or maybe it's developing. Green would be wide and expanding. I know what I'm thinking here.
Yeah, me too.
I have a feeling we're both going to say the same thing. Yep. I'm going to say yellow. Yep.
Santo and Tim agree with us. I'm yellow as well.
Yeah. I do think there is a developing moat here. And when you think about a moat, I like your analysis is there's moat that brings customers in the door, and then there's moats that prevent customers from leaving.
Yeah.
Prevent customers from leaving, that's switching costs, right?
Yep.
The moat that brings people in the door, That
like
would be the
that's brand
intangible,
and business model
brand
starting
name.
out with student
The
loans.
exactly. The market segment, the market segment, although that's not really a moat, that's more of a strategy than anything. Once you're in, you're in.
Yep.
And I think that is good. And then they can make that moat, the door, even heavier on the way out by layering in products and stuff and services on top of that. So I'll be more generous than Morningstar is, I guess we should say.
Yeah.
Okay, great.
Now I'm curious about this next one, the growth, because yeah, why don't you pull it up, and then if you could load that into Gemini, and I was just looking in fiscal.ai and I found something, so I'm going to ask you.
I like looking there first, right?
Okay,
so
all right.
How fast are they growing? So this is a company that's revenue has grown about 30% over the last 3 years. Earnings per share are negative, or at least not growing, given the company's scale. By the way, it's a $20 billion company. Over the next 2 years, Wall Street is projecting 26% revenue growth, long-term earnings growth of about 36% is what we're seeing here. Okay, but how is the company going to achieve that growth? So I have a growth prompt here. We're going to put it in here, and we are going to see what Gemini does.
While it's doing that, I'll point us to it a little bit in a minute.
Okay, so new customer acquisition, definitely.
Yep.
Investing in sales and marketing to get more and more new members. So they added 1 million new members
in the fourth quarter.
Yep.
Wow.
13 million members in
just
total.
Think about that. They added huge. 1 million members in 1 quarter, and they only have 14 million. That's fast growth.
That's a sizable number. Company remains a core engine as the company targets top 10 financial status, and unaided brand awareness reaches an all-time high. Okay. New distribution channels, definitely. Rapidly expansion of the loan platform business, which acts as a distribution channel for third-party capital. This originates $4 billion in 2025. Sofi to grow its reach without stressing its own balance sheet. Very interesting. Geographic expansion, meh. It's primarily U.S. focused, expanding its East Coast presence. Yeah, this is definitely a West Coast bank. With a new $3 million operating hub in North Carolina. I'm guessing that's in Charlotte, which is like the banking capital of the South. International expansion is limited, but its technology platform through management has expressed interest in accelerating international remittance of Sofi Pay. Okay. I don't think it's going to be taking its banking services outside of the U.S. anytime soon, but Galileo for sure. Acquisitions. Can it acquire new businesses to grow? Well, they just raised money, so that means that they could be making a major acquisition. It says the bar is really high, and they have yet to find a financial target that beats internal development. Okay, so that's could be something to watch. Customer expansion. Can they grow by raising prices? Pricing power is driven by a cost of funds advantage.
Same as we've covered.
Yep, it's low cost, means a high net interest margin to undercut traditional banks while remaining profitable. Okay. New products and services. Yes. They launched the Sofi Smart Card, 5% grocery rewards.
That's stable coins, not a small thing. Austin just talked about this right here.
And a blockchain power internal remittance. New products are a primary engine with total products growing faster than members. So total products growing 37% year over year. That just is the stickiness getting stickier.
Yep.
Customer retention, the financial services productivity loop is working. 40% of new products were opened by existing members, up, and the high cross-buy rate indicates strong retention and deepening ecosystem. That's a great metric for them to report.
Yeah.
Right? It's kind of like dollar-based net revenue retention for SaaS companies. Okay, so can this company grow? Number one is investing in marketing and brand building. Number two is keep adding more in services to get its super app flywheel going. Number three is its loan platform business, capital light fee revenue by originating loans for third parties rather than holding them on balance sheet. Okay, that's a cool business to get into, to look into. And then Galileo, and then business banking. Business banking are a much anticipated frontier that could open up a massive SMB customer.
Because right now they're just focusing on individuals.
Yeah. All right. Well, what do you guys think? Does SoFi have growth potential? Red.
I know what I
Nope.
think.
No growth potential. Yellow, good growth potential or decent. And green would be great growth potential. I, I
I gotta go
I don't know
green.
how you don't say it's not great.
Gotta be green. I
Yeah.
mean, with where they
Definitely.
are, there's a small base.
Yeah, definitely green here for me. All right. Now, typically, when we are looking at a phase 4 company, these are the metrics that we like to look at:
This isn't
revenue,
gonna give us much.
operating margin, free cash flow margin, earnings versus estimates, and ROIC. These are not going to be all that useful.
No.
Although we do know some of them kind of already, or at least when you're analyzing a bank, the metrics you need to look at do change. We do know that this company's revenue is growing very quickly.
Yep.
We do know that the company is generating an operating profit, and that number was actually rising.
Yep.
So that one actually is okay. Free cash flow margin, useless.
Yep.
The banks don't have free cash flow in their traditional way. Earnings versus
We can
estimates.
check that.
That's something we can definitely check. And then return on invested capital. ROIC isn't really a good measure of banks here. It's usually return on equity, but that might be relatively limited given SoFi's that it just became profitable. So let's check earnings and let's check return on equity. So this says return on equity is negative 2.1, but that's over the last
over
5 years.
Yeah.
So let's go to
see the
financials.
trends. I want to see the
Yeah.
trends.
The trend definitely matters more than the absolute numbers. All right. So that's going to be under ratios. And then we're going to look at
Capital efficiency.
capital efficiency. And the number we're looking at is return on equity here. Now, for banks, for a sense of scale, a good number for a bank is above 10%. A great number is above 15%, if memory serves.
Mhm.
So yeah, this company is not yet fully optimized for profits.
Which
So
makes
if
sense.
it's at 5 right now. Actually, let's go quarterly. Let's check
Yeah.
quarterly.
Now, it's worth knowing on a quarterly basis, these are numbers you have to add together. So the 2 that it recently got, that's equivalent to an 8. If
Okay.
that makes sense.
Okay. And again, the company is on the earlier side of the profit curve. It's not fully optimized for profits. So there's definitely upside from these numbers. So
To me,
I'm actually going to mark
they're
them as
going in the
positive.
right direction.
Yeah, definitely positive. And actually, you know what? Positive and rising. You're right. It is positive and rising. Now let's check earnings versus estimates and how are they doing. Now I like to check revenue. So let's go quarterly. So these are the actuals. So
We're huge beat.
huge beat, huge
Beat.
beat, huge
Beat.
beat, huge
Beat.
beat, huge
Beat.
beat. That's a
Yeah,
pretty
that's
good track
pretty good.
record. I don't know if earnings per share is going to be useful at all.
Well,
Okay.
with
4,
huge
29, huge beat, huge beat, huge, huge, and
narrow
big.
beat.
But earnings per share with banks, be careful because a banks can make its earnings be whatever they want to be. Any number that they want to be. All they got to say is we took money into loan loss reserves or we pulled money out of loan loss reserves. So do not give a lot of credence to earnings per share with banks. The thing that really matters there is credit quality. But from a general statement, is this a company that exceeds earnings?
Yes.
Absolutely.
Yeah. Some of those revenue ones were huge beats.
Fantastic. Yeah, absolutely fantastic. I would judge a management team by this stage at the revenue. So we're going to skip over free cash flow margin. That is utterly useless for a bank at this stage. But from a rough job with key metrics, pretty darn good. Pretty good there. Let's also point out
key metrics. Can I just ask you to pull up one thing in fiscal? So if you go to financials and then you go to segments and KPIs,
okay,
at the very bottom, it's got something that's really interesting all the way down. It's got lending origination volume by different things, which I think is interesting. But then it also has total technology platform accounts. That's the big one. If you could click on that, and it's interesting because it actually went down, which to me makes me wonder, they must have lost a partner, right? Because this is the total number of, so like they might just partner, Galileo might just have like, I don't know, 20, 25 customers, but it seems like one of them must have left. If I'm not
they would have had
mistaken.
to.
I can look into that while you while we go on to the next step if you'd like.
Because look at the peak. It was 167. Now
And
it's
growing
128.
fast.
Yeah. They essentially, that one customer, let's keep in mind, this is only 12% of revenue, a higher portion of profits. But that, assuming this was one customer, it might have been multiple customers, but that set them back like 3 years.
Yeah.
Or 2 years. Interesting to see. Now, the other thing that I would track for a bank would be net interest margin. I don't know if that's a metric that
It's not.
It's not. I didn't see it in the KPIs.
No.
But that's one that that's a key metric that I would want to track to. I mean, there's so many numbers that you could track with banks. The point we're making here is on a key metrics perspective, from simplifying things, looking pretty good.
Yeah, okay. I agree.
Execution risk. Let's take a look at the risk analysis here. Where is it? All right. I wonder if it's going to identify outside forces. It's a major risk here, and that interest rates are really going to matter. Okay. Overall summary. So this gives it a medium risk rating, a score of 2.25. And remember, that's out of 0 to 3. A risk factor, outside forces, interest rate sensitivity. Number 1, competition, fragmented neobank and incumbent market. High income member demographics is a key mitigation factor, and a low cost deposit base with that national bank charger. Okay. Concentration risk, not an issue. 13 million members, 20 million products. No single customer is 10% of revenue. Great. Disruption risk. This says green. Sofi is the disruptor, and its technology platform provides the AWS of fintech to other institutions. Aggressive vertical integration creates a moat against smaller fintech competitors. I would agree with that.
I
would agree with that, especially with the bank charter.
Mm-hmm.
Outside forces, red. Interest rate sensitivity, 100% increase in markets would result in a $102 million decrease in net interest income based on a sensitivity modeling, and high exposure to credit card cycles, personal loan charge-offs. While currently resilient, they remain sensitive to U.S. unemployment trends for sure. Yep. Short seller scrutiny. Muddy Waters alleges financial engineering and EBITDA inflation, which create headlines and valuation risk. Okay. Competition, red. This is a very fragmented market, and they have pressure from neobanks like Chime and Revolut and massive incumbents moving into the super app territory.
By the way, Chime is who is identified as that major customer.
Oh, thank you. Thank you, readers. Okay. I wonder why Chime would live.
They came up with their own company called Chime Core to process their thing.
Very good.
They went full stack in-house.
Great sleuthing, everybody.
Yep.
High competition to remain from pricing pressure. So overall risk, no concentration risk, no disruption risk, big outside forces risk.
Huge outside forces
big
risk.
Competition risk. Although, let's be fair, the competition risk, nothing new.
No.
The competition has been there the entire time, and this company has grown pretty substantially, even with that major competition risk. And they're defensive. They have the bank charter. They have a high credit quality portfolio, and they have vertical integration. All right, red, yellow, green. What do you guys think of the risk of Sofi? Red, very high risk company. Yellow, medium risk company. Green, very low risk company. Yet again, good.
At first, I was going to say red for this just because financials, but that's more me. Like me investing in a financials is a red because I don't know enough.
Yep.
But I could see how yellow would make sense.
I would argue yellow. I'm going to say it's a reddish yellow or a yellowish red. And to your point, to analyze a company like this properly, to go deep into the actual numbers, you basically have to be able to read that Muddy Waters report and refute it. That's hard. That is just hard to do. That's a very specialized skill. So again, a lot of analysts specialize in banks so that they can dive into those kind of details. But you're basically trusting that management is honest and forthcoming. Okay, now from a valuation perspective, get into that next. We normally would say, oh, look at forward PE, look at forward price to free cash flow. We'll take a look at those. I'm guessing they're going to be utterly useless to us, and probably the better thing to go on would be price to book or price to tangible book would probably be better. So let's take a look at some of those right now. Okay, so we're in financials. Let's go ratios, and let's see what we have. Well, let's just take a look at PE. So this is trailing. Yeah.
42 doesn't really
43 times trailing earnings, but the company is not yet optimized for earnings. So that's not going to be all that useful. I'll click it because it's here. Price to free cash flow, utterly useless. Utterly useless. So that's not a metric that we should look at. Let's take a look at price to book. And keep in mind, we're trailing numbers here. All right. This is a useful number.
This is a
useful number.
How far back is that pulled? Can we pull it back further? Or is that as far back?
Let me change that to annual. All right.
All right. So let's start there.
Yeah. So 2020.
There you
July.
go. Right there.
I'll go quarterly. Give it a little bit more fine tuning. I think that was July of 2021.
There. That's reasonable.
That's pretty good. All right. So high, low, medium. Okay. Median is about 1.63. Got up to 5 times book. Wow. Why so expensive back in September?
I mean, you saw how much it was growing.
5 times book back in September. Currently about 2 times book. The average is about 1.3.
I do wonder when they got their banking charter and if that might be part of that jump.
I don't know. I don't know. I've actually never checked because I don't analyze banks. Do they have forward price to book? Probably not. No, that wouldn't be one. But I think trailing price to book is probably pretty good to look at. Is there anything else here from a valuation perspective that we should look at? I guess PE is kind of useful. Actually, let's look at forward PE. That might be decent enough. Forward PE. Yeah, so we're going to hide the price to book.
27 seems pretty reasonable, all things taken together. And Dennis, we agree. Net interest margin, that's great. We couldn't find that, so it's one thing that we couldn't find on fiscal.
Yeah. So 28 times forward earnings. I mean, they only just became profitable. So the history of using this metric is fairly limited. Keep in mind, during this extreme period right here, this is when they were just break even, basically, right? So this is when they came break even, not all that meaningful here. So if we just said from July 2024 forward, July 2024, this is a decent enough period to look at. So a high of 70 times forward earnings, a low of 27 times. But if you force me to say, pick your favorite, I'm definitely going with price to book.
Yeah. And for what it's worth, I was doing a little bit of research. Some of that rise has to do with interest rates being cut and anticipation for further cuts, because the more interest rates are cut, the more lending happens. The more lending happens, the better for SoFi. And the thing that really started it, having it come down, was that capital raise, because some started to worry that they were doing that because they were preparing for tougher financial times. And that does kind of coincide with when it really did start to drop.
Okay. And back in 2022, when everybody hated anything that IPO'd recently, this company did get below book value.
Yep.
Currently two times book. All right, red, yellow, green. What do you guys think? Is this a company that's red? It's overvalued today. Yellow looks fairly valued today. Or green, it is undervalued today. So if you're emphasizing the forward price to earnings ratio, or you're emphasizing price to book, those kind of speak different things to you. But what would you say, Stoffel?
I mean, you should take whatever I think about this with a grain of salt, but I would land in the yellow.
Me too. I think it's definitely cheaper than it was, but I don't think it's like a screaming bargain. I would probably, if I was really interested in this company, get quite interested below below 1.7 times book, 1.5 times book, something like that to me would be much more interesting. Okay, cool to see. Next, we're going to do. I got to catch up on this whole presentation. I haven't been clicking through.
That's all right. We've gotten so good at it. We don't need the slides anymore.
That's right. All right. Valuation. Okay. Next, sentiment analysis. This should be interesting. Let's take a look at the sentiment. What is the sentiment around the company's stock right now? Well, after falling 50% and having a short seller report, I'm guessing the sentiment is not going to be all that great on this business. But let's see what it says. For the last year, SoFi experienced a massive rally, peaking at 33 as it reached GAAP profitability and record revenue. Shares were retracted due to the scathing Muddy Waters short report and broader macro concerns regarding high beta fintechs valuation.
Yeah, most of the fall happened before Muddy Waters anyway.
That is true. While operational growth remains robust, the stock faces a show me period to disprove the short seller allegations and overcome technical resistance. So analysts kind of appear to be meh. Retail investors love it. The media is meh on it. The short attack, this is definitely a big thing. Insider conviction. CEO has purchased $1 million of stock following the short report. So let's put this in context. What do you think of that?
I mean, I think it's a good vote of confidence, but it, like the market, I'm not going to say, oh, that means everything. If I were to look at Anthony Noto's personal net worth, my guess is that it's yeah. So he increased his position by 0.5%. 0.5%.
Yeah. So this is why scale always matters, right? So he owns about 1% of the company, or less than 1%, 11 million shares, and he just added $1 million. So I did see people were saying he just bought $500,000 worth. He just bought $1 million worth. Anthony Noto just added 0.5% to his overall position. So to me, a meaningful amount of stock would be like 20 million or 50 million or something like that. So I know that a lot of people have been saying this guy does buy a lot of stock in the open market. As a general statement, that's a good sign. But to me, the scale does not to me scream this guy is uber bullish. It's more of almost like a marketing signaling event than I would say anything. He cares a lot more about the 11 million shares that he already has than risking anything else.
Yeah.
Okay. Overall, what do we think of this company, red, yellow, green? So we learned it's a phase 4. It's an operating leverage company. We gave the company a yellow rating for the business, a yellow rating for the moat. The moat is definitely developing and everything's trending in the right direction. We said the long-term potential here is quite good. The key metrics that we could look at and analyze looked very good. Very, very good.
Mm-hmm.
The risk here was yellowish, yellow reddish on the high side. And we overall said the valuation today looks pretty decent. What would you say are the overall numbers that you're seeing from viewers, Sofi?
Yellow is what everybody's saying. For me personally, this is a red, but it has nothing to do with SoFi. Just has to do with knowing what I'm good or not good at. And this is definitely in the not good.
How about this? I will say this. This is a company that's not going to enter my portfolio because I don't invest in banks. But if I did invest in banks, this would be at the top of my list.
Sure.
Because I think it has growth built in. I like the super app-ness to it. It's definitely a good executor. There are some exciting components to this business, so it's beyond just pure lending. The Galileo looks good, although the Chime, them dropping off the Chime. And then they just raised $1 billion, $1.5 billion to acquire something. If they go out and acquired, I don't even know what Chime is worth, but if they went out and acquired another bank, would that make you more interested or less interested?
Less, but again, that's just because it just makes it even more confusing for me. So, but don't pay attention to what I think about it.
There you guys go. Awesome. Well, we hope that was useful for you and that we have the power of using a simple checklist to analyze stocks. Now, we've been teasing this for a while and we're going to continue to do so, but we've been working on a new version of Stock Simplifier in the background for quite some time now. And we are getting ever so closer to
Every
being
week
ready.
brings us closer, guys.
Every week brings it a little closer. So I wanted to show you what this looks like if you're analyzing a bank stock in Stock Simplifier. So here's an example of what it looks like. The new one looks like when you're using the new Stock Simplifier. So we're going to show you some slides for when I was analyzing JP Morgan earlier today. So we have these beautiful visuals that show you how wide the company's current moat currently is. And we prove it with bullet points. And we also show you whether the moat is shrinking or growing. And we use AIs to do some really, really deep analysis on the company. And then we present you with a summary of it there. Another thing that we do with the new Stock Simplifier is we give you analysis of the management team. So again, here's JP Morgan's management team. We say, hey, this is the founder, and we have a picture of the founder. More importantly is we have things like, here's the current CEO. Hey, how long have they been there? 22 years at the company, and he was the CEO for 20 years. How much stock does that person own? So visually, I think this is beautiful and summarizes all the key information clearly. Now, check this out from a valuation perspective. We haven't shown this yet. This is how we're going to show you valuation. So we dramatically simplified things. We tell you what metrics you need to focus on. We make this beautiful graph that's red, yellow, green, very easy to see. The graph automatically adjusts based on when the company's data set is useful, and and the metric that we show you changes depending on what phase, what type of business it is. One thing that I do want to do with banks is I want this to default to price to book.
Yeah.
So that if price to earnings is not meaningful, we can show you price to book. But we can actually now tell what type of company it is and present you the correct valuation metric to make the valuation extremely, extremely simple. So we cannot wait to get this in people's hands. We are still in the beta testing product right now. If you have already purchased Stock Simplifier, keep an eye on your inbox. We have an exciting announcement coming, but we plan on launching that to existing Stock Simplifier users first. They will get it in April. And then if you want to join the wait list for it, we're going to take some time to really continue to develop and refine based on the feedback we get from existing users. And we're going to launch it to the general public in May. If you do want to sign up for the wait list to be notified when it is available, longtermmindset.co/waitlist. Give us your email address and we will add you to the list, and we will keep you informed as we develop this. But we are working our tails off on this thing, and I just cannot wait. I can't wait to get it in the public's hands.
I will just say this. I am very reticent to change anything about my research process. And this is what I use for my first pass on any new stock now. I use it at least once per day.
Yep. Most importantly, after you go through the research process, we keep it on a list for you.
Yeah.
so you can track
your rankings
easily.
Mm-hmm.
I already researched this company. How has my thesis changed over time? These are my buy list companies. These are my watch list companies. These are my I don't want to ever own list companies. So we dramatically simplify the research process. No copying and pasting prompts or anything like that. So more details coming. We do hope that you guys do check it out. We think that the beta testers that we have really, really like it.
And cool. I'll say this to William. When you research stocks and everything that companies need to do when they have outside investors, you realize that you don't want to go public. So there are no intentions of that happening with our little company here.
Yep. Francine asks, when do existing customers need to get on the waiting list? It doesn't hurt to get on there, but if you are already an existing customer of Stock Simplifier, we know who you are. We have your email address, and I've been emailing you weekly. So we will be announcing when the launch date and that, and it is coming up very soon. Yep. Very, very soon. So yeah, love to see that. Cool. Well, thank you guys so much for joining us today. While we are not financial analysts of banking companies, we do hope that this analysis was useful. As a reminder, do your own research, especially on a company like this. Dig into that report. Analyzing bank stocks is something that is very, very difficult to do. And we should also say this at the end. I don't own Sofi. You don't own Sofi or anything like that. So it's good to reiterate at the beginning, at the end, if we own the stock or not. Thank you guys so much for joining us. We will issue a new 4 stocks to research in our newsletter tomorrow. And we'll be back next week with another Stocks from Scratch.
Bye, everyone.
Bye.